In this video, we're going to describe the accounting and reporting for stock compensation plans. In particular, we're going to examine the accounting for stock options. And stock options give employees the option to purchase common stock at a given price referred to as the exercise price over some extended period of time. Stock options are an effective means of compensating employees because they link pay to performance and motivate employees. To the extent that we can motivate employees to act in the best interest of the firm, the company's stock price will increase, as will the employee's compensation. So it's an effective way to align employee and shareholder interests. Stock options can be an important tool for retaining executives and recruiting new talent. Many a software engineer has wandered off to Silicon Valley, hoping to strike it rich with stock options in the latest tech firm. Think about the employees that got in early with companies like Amazon, Zoom, Facebook, or Instagram. Stock options are a useful form of compensation for growing and young companies because it's a non-cash form of compensation. In fact, the company will receive money from the employee if and or when the employee exercises their options. And finally, from the employee's perspective, there are tax benefits. Stock options are not taxed as current income, but rather any gains are taxed as capital gains when the employee ultimately sells shares they acquire through exercising stock options. From an accounting perspective, we have two real issues. GAAP requires companies to recognize compensation expense using the fair value method, which means firms will need to use some sort of acceptable option pricing model to value their options at the grant date. No compensation expense is recorded at the grant date, but rather the compensation expense will be matched with future revenues. So our two main accounting issues are 1, how to determine compensation expense, and 2, over what periods do we allocate that compensation expense, in other words, match it with revenues. Again, the value is determined based on the fair value of the options at a grant date, and we're going to need to use some sort of option pricing model to do that. And then we allocate the compensation expense over future periods referred to as the service period, in which we expect the firm to benefit from the employee's motivated and enhanced performance. Let's take a look at a quick example. We've got the Chin Company on January 1, 2020, approving a plan that grants company executives the option to purchase 10,000 shares of the company's $1 par value common stock anytime within the next 10 years. They've used a fair value option pricing model and determined that the value of the options on the grant date is $220,000. So that $220,000 is our compensation expense, and we're going to need to match it with future revenues. And we're assuming the benefit period is going to be 2 years starting with the grant date. So from an accounting perspective, what's going on? On January 1, 2020, the grant date, there's no journal entry. However, at the end of that first year, December 31st, 2020, we need to record half of that compensation expense. So we'll debit compensation expense for $110,000 and credit an equity account. We'll credit paid-in capital stock options for $110,000. We'll make that same entry the second year to record the second year worth of compensation expense. Now let's look and see what happens if employees exercise some of these options. We're going to assume that sometime in 2023, the executives exercise 2,000 of the 10,000 options, so they're exercising 20% of the options. Chen's going to make the following journal entry. They will debit cash for $120,000. That's the 2,000 options multiplied by the $60 exercise price for each option. They will also transfer 20% of the paid-in capital credited to stock options out of paid-in capital stock options, and we will record entries to common stock and additional paid-in capital common stock. So again, we record the $120,000 in cash we get from the employees for exercising the options and transfer capital out of the paid-in capital stock options account. We credit common stock for $2,000. That's the 2,000 shares, the $1 a share, and the difference, of course, is our plug to retained earnings, or rather paid-in capital in excess of par for common stock. Now, sometimes the options aren't exercised and they expire worthless. Again, options give you the right, but they don't require you to purchase the shares. Let's look and see what happens from an accounting perspective. If the executives failed to exercise the remaining 8,000 options, accountants basically engage in some busy work and transfer the capital from paid-in capital stock options to paid-in capital expired stock options. And again, the 176,000 is the remaining 80% of our compensation expense that was credited to paid-in capital stock options. So from an overall capital perspective, nothing's happened. We've simply shifted the amount from one count to the other. Now, sometimes we do need to make an adjustment for options that are not exercised, and it all depends on why they're not exercised. Again, the company doesn't adjust compensation expense for expired options. They simply shuffle the deck and move it from one capital account to another. But if an employee forfeits their stock options because they fail to satisfy a service requirement, say for instance they leave the company prior to the exercise date of the options, the company will need to adjust its estimated compensation expense in the current period. This is treated as a change in estimate, just as we might have a change in our estimated allowance for doubtful accounts. We thought 2% of the customers wouldn't pay. It turned out 3% didn't pay. We don't go back and change our bad debt expense from prior years. We handle it prospectively going forward. We don't make retrospective adjustments for changes in estimates, such as the useful life of fixed assets, our allowance for doubtful accounts, projected warranty expenses. Again, all of these are handled prospectively, and we'll do the same thing with our compensation expense related to expired stock options. Let's go ahead now and take a look at some examples. In our example, we've got the Sweet Company has adopted a stock option plan that grants options to key executives to purchase 33,900 shares of the company's $10 par value common stock. The options are granted on January 2nd, 2021, and are exercisable for 2 years after the date of grant, if the grantee is still an employee of the company. The options expire 6 years from the date of the grant, and the option price is set at $30 a share, and a fair value option pricing model has determined that the total compensation expense will be $508,500. We're going to begin by recording the entries required at the grant date and to record compensation expense over the 2-year service period. Again, at the grant date, there's no entry made from an accounting perspective. The important thing about the grant date is that's where we determine the fair value of the options. And in this case, it was determined to be $508,500, and we need to spread that over the 2-year service period. So on December 31st, 2021, we need to record $254,250 in compensation expense, and we credit paid-in capital for stock options. So our paid-in capital for stock options account will have a $254,250 balance at the end of the first year. During the second year of our service period, we record an additional $254,250 in compensation expense, the other half, and once again, we credit paid-in capital stock options. Now let's take a look at the journal entries we'll make when the stock options are exercised and if they expire worthless. We're told that on January 3rd, 2023, when the stock price is $67 a share, employees exercised 2/3 of their options, or 22,600 shares. The market price of the stock doesn't matter to the company from an accounting perspective, but it would certainly matter to the employees. They're not going to exercise the options if the stock price is lower than the $60 exercise price per share. So let's go ahead and see what happens. We're going to receive cash. The company will receive cash in the amount of $678,000. That's the exercise price of $30 per share for the options, multiplied by the 22,600 shares that are outstanding, or rather options that are exercised. And I misspoke a minute ago. The employees will only exercise if the stock price is above $30 a share, not $60 per share. So the company records the cash, and they also need to transfer out 2/3 of the capital that has been recorded in our paid-in capital stock options. So 2/3 of the $508,500 will need to be debited, transferred out of paid-in capital for the stock options, and recorded as part of paid-in capital related to common stock and additional paid-in capital. We had 22,600 shares at $10 a share, so that's $226,000 for common stock, and of course the plug is to paid-in capital of excess of par common stock. We're told then on May 1st, 2023, the remaining options are exercised. So once again, the company will get cash. This case, $339,000 in cash. That's the 11,300 options that have been exercised at $30 a share. We're going to clear the remaining $169,500 out of our paid-in capital for stock options. And then, of course, we need to record our common stock in the amount of $113,000 and our plug to additional paid-in capital. Now let's take a look at what would happen if only the options on January 3rd were exercised and that these remaining 11,300 shares weren't exercised. We still have the $169,500 balance in paid-in capital for stock options. So we're going to need to clear that out with a debit to paid-in capital stock options. And again, this is only something accountants would love to do. So we're going to transfer it from one capital account to another capital account, which is paid-in capital stock options expired. And again, we've now cleared out our paid-in capital stock options, and it has a 0 ending balance.